Um, Jeff Tompkins. Jeff, can you hear me?
I can hear you loud and clear.
Go ahead and get your PowerPoint set up.
All right.
Jeff is an award-winning hedge fund manager and chief investment strategist at Altos Trading, LLC. Trading successfully since 1999, he has developed an arsenal of highly tested trading strategies that remain effective regardless of market conditions. His main objective is to teach these disciplined strategies to those striving for success in the markets. Welcome, Jeff Tompkins. So, Jeff, where are you broadcasting from today?
Thanks so much. Yeah, I'm broadcasting from Boise, Idaho.
Good old Boise, Idaho, the home of Micron technology.
Yeah, hot stock.
I met Lisa Sue a few years ago and told her she had to be the best dressed person in Boise, Idaho.
Yeah, there you
She
go.
had the money to afford it.
I was
And
gonna
that was
say.
10 years ago.
Okay, yeah. Yeah, well, once again, thanks for having me. It's a pleasure to be here. And yeah, I'll go ahead and dive in. So, welcome everybody. We'll spend about an hour together today, and I'm going to reveal my golden one-day options trade. So, these are power play trades for volatile markets. I think it's a timely topic as we see the markets pulling back significantly today. So, before I dive into that, I'll cover a quick risk disclosure and disclaimer. Of course, trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and of course need a broker to trade securities and options and must meet suitability requirements. We'll be going over some various results in our session today. In fact, I'm going to share a trade that we just closed out this morning on the S&P. But just know that anything I do share due to the time critical nature of trading, brokerage fees, activity of other traders, etc., don't guarantee that anyone will mirror the performance. All right, so with that out of the way, by the end of our session, you're going to discover one trade setup that has the potential to profit regardless of whether the market goes up or down. All right, and so these opportunities occur on a regular basis with astounding reliability. You just need to know how to spot them, and you will by the end of our session. But whether you're just starting out or you're a seasoned veteran, this is must-have information for today's markets. So I generally start out my presentations with addressing some sort of difficulty that we face because it's easy to sugarcoat things, right, when you're teaching a trading strategy. But the reality is there are challenges with any trading strategy, any market environment. And so let's do that first, and then we're going to talk about how we can overcome this. But when we consider directional trading, and most of us trade directionally to some degree, one of the most difficult aspects of trading is accurately and consistently forecasting and timing market direction. And you can imagine, right, if we had a crystal ball and we knew exactly where the market was going to go, it would make things a whole lot easier. It'd be a lot more difficult to lose money. You still could lose money with bad money management, etc. But nevertheless, that would make things a lot easier. But the reality is we don't have that. And so what happens with most directional trades? So anytime you get into a trade, you're doing so in a very specific market environment, right? And market environments are not static. So inevitably, when you get into a trade, over the life cycle of that trade, the market environment is not going to be what it was when you entered the trade. Something's going to change. And one of those big factors or variables is volatility, right? Volatility is not static. It constantly is changing. And if you look at this graph that's put out by the St. Louis Fed, which looks at equity market volatility, that demonstrates this, right? So this is over the course of about a year. And we notice a couple things. We'll go through periods where we go into volatility expansion. So volatility will steadily rise, and then we'll go into volatility contraction. So it will drop off dramatically. So that's one thing. And so the other thing is that it's erratic, right? And it's somewhat unpredictable. So it can change on a dime. And again, when you're in a trade, this is where things may not go as planned, okay? Because the market's not going to be in the same condition that it was in when you got into that trade. So there are ways to address this. And if you don't need to know whether a stock will go up or down or even when, that removes a huge difficulty, right? It's a big weight off the shoulders. And that's exactly what we're going to do with the Golden One Day Options trade. We're going to eliminate that difficulty. So what I'll give you on the session today to make it easier is number one, you'll discover the Golden One Day Options trade. I'll show you how to identify the setup, how to trade the setup, how to profit from the setup, how to apply this setup to any optionable security. We'll look at some real world, real money trade examples. I always do my best to share real world examples, not hypotheticals, to show you that this actually can work for you as well. And then I'll show you how you can get expert guidance to do this for yourself in the live markets. All right, so before we go any further, I'll just give you a brief high level background of myself. Again, I'm Jeff Tompkins, and I've coached around 30,000 students on a platform called udemy.com. This is kind of where I got started out a little over a decade ago, teaching other students how to trade. And I've been in the market for over 2 decades. So started back in the late 90s, trading on the retail side, trading my own account. Went through all the struggles probably most of you have. And then ultimately got my first glimpse into the institutional side as an intern at the trade desk at Morgan Stanley back in the early 2000s. And then a little over a decade ago, founded Altos Trading, where I currently serve as the chief investment strategist. We've rapidly grown to over 60,000 members in over 100 countries across the globe. And I'm also a hedge fund manager, so I manage money for my clients at Altos Capital. And I'm going to be sharing a lot of institutional level tactics, methodologies, and strategy in our session today. So a lot of what you'll learn today is stuff that's highly underutilized on the retail trading side. And that's ultimately my goal, is to really narrow that gap between the institutional and retail sides of trading, right? Because back when I started trading, that gap was very, very wide. It's as more information becomes readily available to the retail side, that's narrowing, but we have to know how to find it and how to use it correctly, right? And that's what we're going to do today. All right. So as you can see, I'm also a keynote speaker and educator. So I still trade my own account. I still trade on the retail side. I also, of course, trade on the institutional side. But one of the things I really enjoy doing is getting out and educating and helping retail traders reach higher levels of success and consistency and confidence. All right. So let's get into the strategy. What if we could profit if the market goes up or down? Now, today's a great example, right? We're getting a sell-off in the market. And with this type of strategy, which we call a market neutral strategy, okay, we don't care which way the market goes. It could skyrocket or it could sell off, kind of like it is today. And now with the golden one-day options trade, okay, we don't need to use any special indicators. There's no lagging indicators, MACDs, RSIs, stochastics. Okay, you can throw all of that out the window. There's no complicated chart analysis. In fact, you can do this trade without even looking at a stock chart. We will be incorporating a little bit of chart analysis because there's a technique I'll share with you that can give us a little bit additional edge. But we don't even need a chart to do this trade. Okay, there's no guessing trend direction. So again, the underlying can go in either direction. We could tank to the downside or we could rally to the upside. Okay, there's no need to time the market, so we're not using any seasonality, tactics or anything like that. And then there's no uncertainty when to take profits. So you're always going to know when you get into this trade exactly where to get out. Okay, and this is all a proven strategy based on statistics. So it's not theory, it's not hypothetical. This is something that works in actual live markets, and I'm going to again share with you some real world examples. So you're going to discover why volatility is one of the only leading indicators of impending trends, how to identify when markets may be primed for a big move, how to build a trade that can profit regardless of which way the market goes, how to set accurate profit targets with limited defined risk, how to play smart money trades. And by smart money, I mean, again, we're going to be using tactics that are more on the institutional level side that again, I think are highly underutilized on the retail trading side. And whether you trade options or not, this is critical information to have and really should be incorporated into any of your trading decisions, even if you're just trading the stock or the ETF. Okay, and there's a whole lot more. So let's dive a little bit deeper now, and we're going to start by looking at volatility. Volatility is going to be an important component of the golden one-day options trade. Now, there are essentially 2 main types of volatility. There's historical volatility and implied volatility. So as the name suggests, right, historical is what's happened in the past, and implied is what's expected to happen in the future. So we're mainly, of course, concerned about implied volatility, right? So if we're going to build a trade, we want to have some idea of what the volatility is moving forward, what the expected move of the stock or whatever we're trading is. Okay, and so implied volatility is the option market's forecast of future price movement. And it's going to tell us with a high degree of accuracy how much an underlying asset share price is expected to change by a future date. Okay, so that's very important information to have, and probably some light bulbs are starting to go off. You know, you can do all kinds of things with that information, like setting realistic profit targets, defining your risk, all kinds of things, okay? And we can find this in the options chain, and it's going to tell us the exact number of points the market's forecasting the asset to move up or down. All right. Now, I want to give you just a quick high-level overview of implied volatility if you're not familiar with it, so that you understand why we're using it for the golden one-day options trade. So it's basically a measure of how much the market expects the price of an asset to fluctuate in the future. And if you're familiar with the Black-Scholes model, which is a very complex formula for how options are priced, um, it, it's a key factor in determining the price of the option contract. So really that complexity can be boiled down to implied volatility, and there's a direct correlation. So when implied volatility is high, option premiums are more expensive, and conversely, when it's low, they're less expensive. So we can use it for that purpose, right? To gauge whether options are cheap or expensive, but also to determine the possible outcome of an options trade. So like virtually anything else in markets, in financial markets, right? It's influenced by supply and demand. So if there's demand, right, and buyers are coming in, the option premium is going to get more expensive, right? So here's the key. Implied volatility tends to increase ahead of a major announcement or event and then decrease after the event has passed. And so the example I typically use is a company's quarterly earnings announcement, right? Is you're leading up into that, what I call a known unknown event. We know it's coming up, but we don't know what the outcome is going to be. And if you were to plot implied volatility below the chart, you would see it ramping up or increasing going up to that event because there's uncertainty, right? And so implied volatility is going to increase. There could be a big move that we aren't able to predict or know which way it's going to go. But once that information is known, you'll see implied volatility drop off a cliff, right? And we call that vol crush. Okay, so I want you to keep that in the back of your mind as we dive a little bit deeper, because that'll become important for the golden one-day options trade. Now, there are different ways to measure it. And when we look at implied volatility percentile, we use a scale from 0 to 100. So this is my interpretation of different levels of volatility. And that is that 0 to 20 I consider to be extremely low, 20 to 40 quite low, 40 to 50 more in the medium range, 50 to 80 moderately high, and anything above 80 is extremely high implied volatility. All right. Now, it also forecasts the expected move up or down of the underlying security with remarkable accuracy. Now, it's not perfect, and that's okay. It doesn't have to be perfect, but it is remarkably accurate over the long run. Okay. And it's also not going to tell us which direction the underlying stock will move. But again, that doesn't matter because we're going to be using a market neutral or non-directional strategy in the golden one-day options trade. So the market could go either way. It could skyrocket or tank. It doesn't matter. Okay, so let's start to apply some of this. We're going to look at an options chain, and this is not a current chain, by the way, but that doesn't matter. You could apply this to a chain today, and I'm going to walk you through what we're looking for here. So this is a chain of the SPY, the S&P 500 ETF, all right, and this is out of the Thinkorswim platform, so this information might be located in a different spot in your respective broker platform, but it should be there. And if you can't find it, I'll show you a way to estimate it. Okay, but we're going to go over to the right of the expiration cycle. Okay, so we're going out to the October 7th expiration. We're going to go over to the right, and we're going to see a percentage and a number. Okay, and we're going to ignore the percentage, which is basically an annualized vol percentile. What we're concerned with is that number just to the right of that percentage where it says 3.98. Okay, so what is that number telling us? Well, first of all, that number is what we call the expected move or the implied move. And it's telling us that the options market is expecting the SPY to go up or down by roughly 4 points. Now, we need to put that in context. When I referenced this options chain, it was on October 6th. So we're going one day out in expiration. And so it's telling us that over the course of the next 24 hours, the SPY is expected to go up or down by roughly 4 points. So again, light bulbs should start going off because we can do all kinds of things with that information, right? So imagine if you're day trading the SPY, let's say. We're not even using options right yet, okay? And you go long the SPY, which at this point in time was trading around 573 a share. Okay, would you want to place a a profit target, let's say up at 579. Well, no, that would be well outside the expected move, and you'd have a low probability of reaching that price level on October 7th. Or conversely, would you want to, place a stop loss at, let's say, 570? Well, you'd have a high probability of getting stopped out because it's inside the expected move. So again, there's all kinds of things we can do with this expected move number. We're going to be doing something else, a unique approach to apply this to the golden one day options trade. So I'll demonstrate that here in just a second. But as I mentioned, if you're not able to find this expected move number in your platform, there's a way to estimate it, and that is to just add up the at the money straddle, meaning that you take the strike price closest to the underlying share price, so that'd be the 573 strike, and then you just add up the premium at the offer on the call and the put side, and that's going to give you a pretty rough estimate of the expected move. Okay, so let's start to build some strategy into this, all right? And again, we're going to use a market neutral non-directional strategy, meaning that the underlying that we're trading the options on can go in either direction. We don't care which way it goes, okay? And there are a lot of market neutral or non-directional strategies out there. I'll highlight some of them and talk about some of the drawbacks, and then we'll look at the one we're actually going to use. So one's an iron condor. Now, iron condors involve selling call and put credit spread simultaneously. They're essentially market neutral or non-directional. You want the underlying to stay within a narrow range. And they have the potential for consistent gains, but they carry high risk relative to reward. So they have unfavorable risk reward skew. Okay, so we won't be using iron condors. Another is an iron butterfly. So iron butterflies have limited risk, limited reward, and they basically profit when the underlying asset stays within a narrow range. Okay, and so there's some inherent challenges there, right? The asset has to trade within a fairly narrow range, and you have to be able to forecast that. So we won't be using iron butterflies. Another is a short strangle. So short strangles involve selling out of the money call and put premium. And so they have limited profit potential, limited to the credit you receive when you put the trade on, but unlimited directional risk. So if the market does make a big move, you can experience heavy losses. So we're not going to use short strangles. Okay, what we are going to use for the Golden Monday options trade is a long strangle. So long strangles have limited risk. Okay, they're limited to whatever you decide to invest into the trade with unlimited profit potential. Okay, and you don't need to guess which direction the market's going to go, or the stock, or whatever you're trading, right? It could go up, it could go down. It doesn't matter. Okay, so this is what we'll incorporate into the Golden One Day options trade. So I'll break this strategy down briefly for you. So if you're not familiar with it, you understand what it is and why we're using it. But it's pretty simple. It just involves two option contracts. Okay, so this is where we buy a call at a higher strike and then buy a put at a lower strike with the same expiration date, same underlying asset. So pretty simple. Okay, and we use it when we believe the underlying asset will make a large price movement, but we're not sure which direction. Okay, or we don't want to be concerned with trying to predict a directional move. Okay, and we have limited defined risk. So, and we're going to look at some actual trade examples, but whatever we decide to invest in the trade is our max risk, right? But it has unlimited profit potential to the upside and substantial profit potential to the downside. Not unlimited to the downside because the stock can't go below zero, right? It's bounded, but theoretically it could go up indefinitely. So we also don't have to predict the trend direction. Okay, and again, this is a big weight off the shoulders. So we're not trying to figure out, is the market going to go up or down? It could have gone either way today. We had a non-farm payroll pre-market, today, and we got a hot non-farm payroll, right? And there are, continuing inflation concerns, and now possibility of raising rate, FOMC raising rates, right? So, so markets are selling off today, right? But that's great for us. We don't care. We could have rallied, we could have sold off, doesn't matter. Okay. And again, I'm going to show you an actual trade that we closed out using the Golden Monday options trade this morning. Now, we can profit if the stock goes up, if we can profit if it goes down. Now, if a strong directional move does not occur by expiration of our option contracts, we can actually adjust this strategy to mitigate the risk and even in some cases generate a net profitable outcome. And I'm going to also share with you some powerful adjustment techniques when things don't go as planned. Because let's be real, anytime we get into a trade, right, it's always possible things don't go as planned because market conditions change constantly. Okay, so we'll talk about that. Now we're going to incorporate one more thing into the Golden Monday options trade, and then we're going to go through the 4 steps to build this trade, and we'll look at some real world examples. So we're gonna incorporate zero DTE option contracts. Okay, and I'll explain what these are if you're not familiar with them. Probably a lot of you are. They're all the rage these days. They're relatively new, so they're becoming more and more popular, and especially on the retail side. But they're basically contracts that exist for a single trading session and then expire on the same day that they're traded. Now, I'll just say one thing here real quick. When we do the Golden Monday options trade, we can do these with 0 DTE or 1 DTE. Okay, and I'll show you some 1 DTE examples. We just don't want to go any further out in expiration than that. And what's really exciting is that, as I mentioned, these have become more and more popular. And in fact, this is an outdated stat. This was probably from a couple of years ago, where the NYC looked at retail option volume in short duration contracts, so 5 or fewer days, and 56% of the retail volume was in these short duration contracts. And now I think it's up in like the 70 percentile range. So a lot of the option volume is in short duration contracts. And this has changed the whole market dynamic. It's made a dramatic difference in how the market behaves. But this is great for us as a Golden Monday options day trader. All right, now here's the reason, right? 0 DTE option prices are significantly impacted by short-term moves in the underlying security. So if you're wondering why are we using 0 DTE, why are we not going out, 2 weeks or 30 days? Okay, this is the reason. And I'm going to explain why. It relates to one of the option Greeks. But what it means for you is significant profit potential if you know how to harness it to your advantage, and you will by the end of our session. All right, so why do we use 0 DTE? Well, it's related to gamma. So gamma is, of course, one of the options Greeks. You have delta, gamma, theta, vega. And gamma, okay, is the rate of change for an options delta based on a single point move in the delta's price. So it's basically a risk metric that measures how quickly an options delta changes in response to a $1 change in the price of the underlying asset. Now, here's the key. 0 DTE at the money options, okay, gamma's at its peak, which means that a small change in the underlying asset price can lead to a large change in the option delta, which of course in turn leads to a large change in the premium. So the example I use there is you take trader A, trader B, okay, you give them the exact same strategy, okay, pick any option strategy. You give it to both traders. They both traded on the same underlying stock, okay, same strike prices. Everything is the same except the expiration cycle. So one, let's say, does it on a 0 DTE, one does it 30 days out in expiration. Okay, both trader A and trader B are going to be exposed to the exact same movement in the underlying stock. Okay, all variables are equal except the expiration cycle. That trade, in terms of the P&L, the profit and loss, is going to behave dramatically differently than one versus the other. So you get an equivalent move in the stock. Trader A's position, who may have done a 0 DTE trade, is going to be impacted in a dramatically different way than trader B, who traded it 30 days out in expiration. And a lot of people don't realize when you sell short duration premium, you're exposed to a huge degree of gamma risk. And it's been ingrained, if you trade options, it's ingrained in all of us that options decay, right? And they decay faster as you get closer to expiration. So naturally you think, okay, now that we have 0 DTE contracts, if I'm selling 0 DTEs, they're going to decay very rapidly. And that can be true. And that's the way to go. But without realizing there's a huge amount of gamma risk. So if you do get a big directional move, you're going to suffer very significant losses as an option seller. But as an option buyer, we can use that to our advantage. We want big directional moves, right? And we can see these premiums increase dramatically inside a single session. So this can benefit the savvy short-term trader if you understand how to harness its power. And again, you will. All right, so let's start to build the Golden Monday options trade. Okay, we're going to go back over to this options chain of the SPY. Okay, and how are we going to use the expected move? So first of all, okay, we need to reference the current underlying share price. So at this point in time, SPY is trading around 573 a share. All right, and we're looking at the options chain on October 6th. We're going to go out one day to expiration. So we're doing this one 1 DTE. Okay, so we're going out just to the next expiration cycle, October 7th. Okay, SPY has expirations on every day of the week. So first step is to go and over to the right and reference the expected move. Okay, we need to know what the option market is forecasting the underlying asset to move, right? And in this case, and we'll round here to keep things simple, that's roughly 4 points. So the option market is expecting the SPY to go up or down by roughly 4 points over the course of 24 hours. Okay, so step one is to buy a call and a put with strikes near the outer edge of the implied move. And I use that term interchangeably, right? Implied move, expected move is the same thing. So, okay, first of all, the implied move or expected move is reached a very high percentage of the time, like more than 90% of the time. So it's rather unusual that we don't reach this expected move level. It can be exceeded. And for the purposes of the Golden Monday options trade, that is perfectly fine. In fact, it's all the better. So if we exceed it, fine. Okay. But most of the time, we're going to be hitting that expected move. Okay. So that's important to know. All right. But we're going to use that expected move number to build our trade and select our strike prices in the long strangle. So if we add and subtract 4 from 573, it's going to tell us to buy a 577 strike call and a 569 strike put. Okay, so this is how we build our trade using the expected move. Okay, and so as with any strategy, we have to define our risk, right? So I mentioned earlier, the max risk for this trade is whatever we choose to invest in it, right? So it's just the premium we pay for the contracts. We don't need to use stop losses. So we do what I call sizing for zero, and we determine our risk up front, okay? And then we back into the position size. So we allocate the number of contracts that would equate to that risk if the premium went to zero. So we're not using stop losses, okay? And that's something we do at Altos. We size all of our trades for zero. We never use stop losses, okay? That's a whole nother topic, but that's a big mistake that people make. They over leverage and trade more contracts and then use a stop. Okay, big mistake. You're just creating an edge against yourself. Okay, so enough about that though. The fun part is defining the reward. All right, so because we're harnessing gamma to our advantage, and these short duration contracts can make extreme moves in short periods of time, I've seen these contracts go up, 2, 3, 4, 500, even quadruple percentage, increases in a single day. It's not unusual. And we're seeing a lot of that happen today, in fact. So we're going to be relatively conservative here and only target 50 to 100% return. Only, right? That's pretty good. Who wouldn't want to make 50 to 100% in under 24 hours? Okay, so we're simply going to add up the premium paid for the put and call contracts and predefine our exit price. So there's no need to identify profit target levels on the chart, none of that, okay? And again, we're going to build one of these and look at some real world examples as we move forward. So let's go back over to the chain, all right, and get to step 2. So we want to add up the put and the call premium to determine our investment or total risk into the trade. Okay, so if we add up the premium at the offer on the call side, which was 27 a contract, and then on the put side, which was 66 a contract, okay, we could put this trade on for $93. So this can be done inside small accounts, and of course, it's entirely scalable depending on your risk tolerance and account size. And we're going to use 10 contracts in our examples, so a 10 lot. But you could put this trade on for $93, okay? And that's your max risk. You can't lose any more than that, okay? As long as you don't mess with the trade or add to the risk or anything, right? So that's our risk, okay? And step 3 is then to set our profit goal. And we're gonna, I'm gonna give you a little trick here, okay, to do this, because we really have 2 approaches that we can use, okay? But first we're gonna target 100% return on this trade example, okay? So we're looking to double our money in under 24 hours. We're paying 93 for the spread, right? So to double our money, we would get out at $1.86. So this is the limit order that we would route to our broker at $1.86. So that's one option. We could just route one limit order, and if we hit that on either the call or the put side, it just is going to take us out of the whole position, okay? So like if the market sells off, we hit it on the put side, it'll take us out of the call contracts as well. But what I like to do, and this is option number two, is to route two separate limit orders, one on the call side and then one on the put side. And the reason for that is that while it doesn't happen every time, occasionally you get, a directional move, let's say to the downside, and then an intraday reversal and the market goes back up. And so there are occasions where you can hit this on both sides of the trade. So rather than just routing one limit order and giving yourself one opportunity, why not route two and give yourself an opportunity to hit it on both sides? Okay, so that's step four. We're going to submit our GTC, and especially if you're doing these one DTE like we are in our example, okay? Because if you do them zero DTE, you can just use a day order, but GTC is a good till canceled order. If you get filled on this the day prior to expiration, okay, make sure to use a GTC when you route your profit target, your limit order, so it doesn't get canceled out by your broker and isn't working for you the next day. Okay, so we're going to route that at $1.86. Let's see what happened here. So we're going to fast forward to October 7th, okay, the very next day. And first of all, what did the S&Ps do? And again, we didn't care which way they went, whether they rallied to the upside or sold off. In this case, they went down, and it wasn't any major sell-off. They were down 0.95%, but they actually exceeded that expected move, which remember was 4 points. So they were down 544 at this point in time. Okay, so 0.95% move to the downside, exceeding the applied move. What happened to our 569 strike puts? But remember, we could have bought for 66 a contract. So they traded up to a high of 254 intraday. So that's a huge percentage increase in that premium inside that one day, October 7th. Okay, remember our profit target was $1.86. So we easily hit that. And in this case, it was on the put side. Okay, so if you traded a 10 lot on this one golden one day options trade, you have a $930 profit potential in one day. Okay, this is very realistic. Okay, this is a realistic profit target. All right, I'll show you some real world examples so you can kind of see how we build these. This is one we did back in September on the Qs. Okay, so I like to do these on the SPY, the Qs, index products. You can do them on individual stocks as well. All right, so this one we did on the Qs, September 16th. This was a 1 DTE. Remember, we can do 1 DTE or 0 DTE. We just don't want to go further out in expiration because we start to lose that gamma edge. All right, so in this case, we identified the expected move. We added and subtracted it from the current underlying share price of the Qs, and that told us to buy a 596 strike call and a 588 or 586 strike put. So a 10-point wide strangle. All right, and that one was done for $1.45 debit. So you could have put this trade on for $145. Okay, on a 10 lot, we're investing $1,450 in this trade. Now, in this case, we weren't in real significant vol expansion. If I remember correctly, vol was kind of flat or maybe declining a little bit. So we were conservative on this one, and we were targeting a 50% return on investment. The very next morning, September 17th, we hit our profit target and exited at a 215 credit for a $705 profit potential on a 10 lot. Okay. And we were, I think in this trade, we got into this like right near the cash close on September 16th, and we were out early in the session the next morning. So we had very little market exposure in this trade. Okay. Due to the overnight futures trading and all that, we were able to get it out of this trade early on September 17th. Okay. Here's one we just got out of this morning. So we entered this one yesterday near the cash close on the SPY. All right. And so entry was near the cash close yesterday. We got into this one for $1 debit. Okay. So you could put this trade on for $100. And then we got out of this one. So I'm in the mountain time zone. If you look at the execution time, 1 minute and 2 seconds after the opening bell this morning. Okay, so we were actually in this trade in terms of market exposure for like 10 or 15 minutes. Okay, so this one hit its profit target right near the cash open this morning, and we got a gap down, right, due to the non-farm payroll report. And look where we got out. Okay, at just slightly over 1 minute into the market open this morning, a $3.02 credit. Okay, that's over a 200% return on investment. Okay, So this is a one we just closed out this morning. Okay, and again, this is all scalable. You can do this, uh, you know, with small accounts. Okay, you can do it one lot, scale it up based on your risk tolerance and your account size. Now, I want to give you some tips as well here that are important. Okay, one is vol crush. So volatility crush, we talked about. I use that example of a company's quarterly earnings announcement. Okay, so it occurs after an anticipated event that results in contraction of price movement. And because implied volatility is a major component of option pricing, it can cause the option premium to decrease rapidly, which we don't want to have happen, right? It can negatively impact the value of the calls and the puts in the strangle. So long strangles that we're using for the Golden Monday options trade benefit from an increase in volatility. So we want to place these trades when we expect volatility to increase or remain high. Okay, so that's important. Now, I also mentioned we can do this trade with even looking at a stock chart. In fact, we just built that SPY trade without even looking at a stock chart, right? We're just using expected moves. But we can gain a little bit of an edge by using price action analysis. And I'm going to show you a way to, obviously we can look at vol percentiles and implied volatility. There's some additional complexities there that we don't have time to get into, but there's a way to visualize that just by looking at a price chart. And the first thing to know is volatility always alternates between contraction and expansion, always, right? And so when we're in vol contraction, inevitably we're going to transition into vol expansion and vice versa. And the way to visualize that is just look at the high-low range of the candle. So a wide high-low range is going to indicate expansion and a narrow high-low range contraction. Okay, so we're just looking at the high-low. And if we look over to the chart to the right, the far left candle, what do we see? It's a relatively narrow high-low range. Okay, right? We're probably in some vol contraction. If we go to the next candle to the right of that, what do we notice? A significant widening of the high-low range. And you'll often see this occur around major shifts in a trend or turning points in a stock. Okay, so we go from vol contraction to vol expansion. We see the widening of the candle range, and then we get a big directional move, right? So there's our big vol expansion. And again, it always alternates. So when we're in vol expansion now, inevitably we're going to go into vol contraction. You'll see the high-low range narrow. And then we go into vol expansion, contraction, expansion, contraction, expansion, contraction, so on and so forth. That always alternates. So just remember, you want to structure this trade when you're expecting volatility to remain elevated or increase. But occasionally you'll get caught in vol crush. Okay. Again, none of us have a crystal ball. We can't know exactly what the market's going to do or what the vol environment's going to be. So there will be occasions when that happens. And there are ways to adjust this trade when things don't go as planned. So I'll give you a couple ways to do that. And that both basically involves selling premium on the call and the put side when the market doesn't move as expected. So remember, a high percentage of the time we fulfill that expected move or exceed it. But there are times when we don't, right? So we can convert this Golden One Day options trade into either an iron fly, an iron butterfly, or an iron condor to bring in premium to cover the loss in the long call and long put when the market is flat and in volatility contraction. And when you execute this correctly, right, in the right situation and the right using the right strikes and all of those things, this adjustment technique can mitigate a loss and even transform a losing strangle into a net profitable spread. Now, we don't have to do this a whole lot, but there have been circumstances where we use this approach. And for instance, so that, we put on a long strangle, the market just wasn't moving, and we went and converted it into an iron fly. So we sold in at the money straddle and left our original trade alone. We just didn't touch it, right? And we brought in premium for doing that exceeded what we originally paid for the long strangle. And as that short straddle decayed, we exceeded the loss on the original position and came out with a net profit. Okay, so those are a couple ways to make adjustments to this trade. All right, so these can be traded within small accounts. All right, you can literally start with $500. We looked at that SPY example. You could put that trade on for $93. Okay, again, you determine your contract size, your position size, your risk tolerance. So the Golden One Day options trade is just one of the dozens of strategies that we use inside of our Altos Live trade room. So I'm going to let you know how you can watch us do this in actual live markets. but also learn a bunch of our additional highly effective and powerful trading strategies. So we don't just trade the gold one-day options trade. We trade a lot of powerful equity strategies, ETS strategies, other option strategies, futures, currencies. We pretty much trade everything. So we're not a one-trick pony. We have an arsenal of highly effective strategies that have proven themselves over decades. We meet with our members 2 times a week on Tuesdays and Thursdays, and we trade the last 2 hours of the U.S. equity session. So 2 to 4 p.m. Eastern time is when we meet for our live trade room. And I'm going to give you actually a little inside peek into the trade room here in just a second and show you. I'll show you our actual trade journal. So we log all of our trades that we do. You'll see our recently closed Golden Monday options trade from this morning. I'll show you where we meet. It's all interactive. So it's an open chat. You get to ask questions, and I'm there hosting it with you twice per week. All right. And again, we have the Golden Monday options trade is just one of our highly effective strategies. We have a lot of really powerful strategies that you'll be able to learn in the trade room. Not only do you get to look over my shoulder as I place trades in my own account, I'm teaching you how I'm doing them. So it's just not just a copy and paste, which you're welcome to do, but it's also a learning experience. You get to learn how to do these strategies for yourself. This is just more real world proof right out of my personal Thinkorswim account, trading the E-mini S&P futures. And again, this is just one of the strategies that we utilize, okay, out of dozens. This is our track record from the beginning of this year. So we're absolutely killing it this year as well. So this is January through the end of May. We've closed out 106 positions for a 75% win rate and a closed P&L of over 36,500. So guys, I want to make a promise to you. I want to help you achieve a new level of confidence and consistency in your trading, and I'm going to give you access to trade alongside me. So this is a unique opportunity to trade alongside a hedge fund manager, and I don't know of any other hedge fund managers out there that will allow you to do that, but I'm totally open to it. I'm willing to. I've been doing this with our Altos members for a long period of time. It's been very, very successful. And so I want to invite you to have that opportunity as well. And as I mentioned, I reveal everything. So I don't give you a redacted version of any of our strategies or tools or indicators that we're using. You get the full thing. Okay. Every special technique, every tip, trick, strategy that make profits like I've shared with you on the session possible. I don't hold anything back. Okay, so I'm going to walk through what you get with your live trade room membership, and then I'm going to give you a little inside peek into the trade room. But you get a membership to the trade room. Okay, you get exact entry and exit signals. So we send out push notification alerts as well as email alerts for every trade that we do. You get the live interactive sessions. All of these are recorded. So I realize a lot of people have day jobs or maybe out doing other things during the day, and that's perfectly fine. Probably 95% of our trades are not real time critical. So you don't have to be there live, right? You can get the alert, execute the trade on your phone or whenever you're ready to with your broker. Okay, so it's not real time critical, but they're all recorded so that you can go back and review all of our sessions. And in fact, you're going to have immediate access to hundreds and hundreds of hours of past sessions and all the learning behind that. Okay. You get full support and coaching from me on these sessions twice a week. So I'm there with you twice per week. Only limitation is I can't give you personal individualized trade advice, but I'm there to help coach you and teach you and help you become a more consistent, confident trader. And these are all proven strategies, tools, and education, not based on theory, right? Not hypothetical. This is real world stuff that actually is proven to work. All right, and an opportunity to trade alongside a professional hedge fund manager. So this is all designed to help you cut the learning curve, get to that next level wherever you are now. Some people might just be starting out. Other people might have been trading for years and just want to reach that next level of success. And that's what we're here to help you do. All right, so again, you're going to get exclusive access to the Altos Live Trade Room. Okay, you're going to get real-time option alerts. Okay, we're also going to be sending you alerts outside of the trade room hours. So not only do you get trades during the trade room, you're going to get alerts outside of the trade room as well. You're going to get weekly strategy sessions. Okay, you're going to get access to our private invitation-only Facebook group of around 1,000 members. You're going to get additional online on-demand option training. You're going to get access to our institutional level options boot camp. Okay, and ultimately learn to trade stocks, futures, forex, and options with consistency. You're also going to get two really powerful bonuses. So one is our latest indicator, or price action pivot indicator. This is a must-have for your directional options trades. So it's zero lag. There's no lagging component to it. It's entirely based on price action, and it accurately identifies turning points in any asset. You can apply it to futures, forex, equities, ETFs, you name it. Okay, you're going to get that indicator, as well as another online on-demand course, how to win 97% of your options trades. So we do a lot of option selling at Altos as well. And this is one of our core option selling strategies. And by far one of our most profitable and powerful strategies. We've been doing this for over a decade with our members at Altos. And in fact, we've exceeded that success rate. I think we've done somewhere, it's over 400 trades. Okay. And I think it's somewhere around 425 or something like that, somewhere in that neighborhood. Okay. We've closed out every single one of those but one. So we've had one net loss in over a decade. So we've closed every single other trade out net profitable outcome. Okay. And in this course, I show you exactly how we accomplish that. So the total retail value on this package exclusively for the Mad Hedge Summit is over $10,000. Okay. We are providing an extreme discount here, and you can get all of this for just $297 a quarter. We also offer an annual option if you're really committed and you want to lock in the entire year. You have that option when you go over to the order page, which is at Altos Trading. Oh, shoot, I have another typo in there. I thought I took that out. It's actually just altostrading.com/LTR. So ignore the live there, and we'll get that correct link in the chat. Altostrading.com/LTR. That will take you over to the page where you can select either the quarterly option or the annual option, and you get an even bigger discount if you do the annual. And I'm going to give you just a quick inside glimpse into the trade room, show you guys where we meet. So this is what the trade room looks like. Okay, you're going to get a member login to this. Again, we post all of our trades. You can see our Golden Monday options trade we just closed out this morning in the trade journal. So you can see all of our trades going back to the very beginning. All right, and our portfolio summary is up at the top. So we started with a model portfolio of 100,000. On closed positions, we have just over doubled that account. Okay, so we've done remarkably well. We obviously still have some open positions as well. This is where we meet. So when, next Tuesday, when we have our next session, this is where you'll be going. And again, it's all interactive. So you have open chat. This is where you're going to see my screen. So this is where you'll see my trading platform where I'll be placing all the trades. This is where we send out our trade alerts, our push notification announcements, and you can find all of our past trade alerts under the announcements. They're all posted here. And again, we send these out by email as well. And all of our past recordings. So again, you're going to have immediate access to hundreds of hours of education from all of our past live trade room sessions as well. All right. And then you get the two bonuses. All right. So you're going to get our price action pivot indicator, which is entirely price action based, as the name implies. So there's no lag to it. Okay. And it uses a unique pivot point analysis to identify, reliably identify major shifts in the trend. Okay, so this is again a must-have for your directional options trading, or directional stock trading, or directional futures trading. You can use it for any asset. It can also be applied to any time frame. Okay, and we have two versions of this indicator. We're giving you the pro version, which allows you to adjust this indicator to your trading style. Okay, and I love using this for my directional option strategies. So if I'm doing a vertical call or put debit spread, this is a must-have, right? And it helps you remove the guesswork without using lagging indicators. Okay, we have this available on two platforms, TradingView and Wealth Charts, and we're in the process of programming it and developing it for broker platforms as well, like Thinkorswim, TradeStation, NinjaTrader, so on and so forth. Okay, but you'll get to choose which platform you want it on. And ultimately, when we roll it out for the broker platforms, you'll get to select one of those as well, and that's part of your package. There won't be any additional charge for that when those are available. All right, and you get the bonus number two, how to win 97% of your options trades. Guys, it only takes one winning trade to pay for your membership to the live trade room, right? So we've of course priced this at an extreme discount to give you the opportunity to get in if you're serious about learning from a hedge fund manager and learning more strategy beyond the golden one day options trade. We get hundreds and hundreds, if not thousands, of 5-star testimonials from our members. You can check those out. We also have what's called our Altos All Stars. So these are actual live interviews I do with our members who have used these strategies, and they share their success that they've had with them over the years. So again, I want you to be my next success story, obviously, but I also want to demonstrate, this isn't theory. These are real people that have had tremendous success with this. All right, and we have a double your money back guarantee on this as well. So we want you to be confident in your commitment here. We realize it is a commitment, and we want you to go into this with confidence that we're here to back you up. We want to see you be successful, and we want to see you ultimately be profitable. So if you haven't earned at least the cost of your membership fee back in the first 90 days of trading with us, and that could even be that you just paper trade, which we encourage you to do, right, to begin with, as you're learning the new strategies. That's perfectly fine. Just let us know. Okay, and we're going to give you $2,000 to spend on any of our products and services. So we'll give you a credit to do that, and we have other really successful, powerful indicators, alert services, a lot of really good stuff, and we'll comp that for you if you haven't been able to earn your membership fee back in the first 90 days. Okay, I'm going to go ahead and open it up to questions here. So if you have those and you want to put those in the chat, I'm happy to answer any questions that you guys have. Let me just get this pulled up on my screen so I can see these as they come in. And so yeah, any questions on the golden one day options strategy, the live trade room, any questions you guys have, you can put those in there. And again, I apologize about the link there. That link is altostrading.com/LTR. So you can just take out the live. That way you can get the quarterly option as well. Otherwise, it's gonna give you the annual option, and you have that as well at altostrading.com/LTR. But some people might want to just start with the quarterly instead of going to the full annual. So that's totally up to you. All right, let me just check the chat here, and let me make sure I got this. All right. Okay, so Sebastian said you've been trading since 1999. .com crash, 2008, COVID, AI boom. Which market regime was the hardest to adapt to, and what did it force you to change? Yeah, good question. So yeah, I have traded through virtually every market environment. The bear market of 2022, the tariff crash. In fact, I launched my hedge fund in January of 2020, so right before the COVID crash. And we traded through that and came out with, we've actually never had a losing year in the hedge fund. We've had positive years since we launched it, but had virtually no drawdown in the fund during the COVID crash. And so really I credit a lot of the methodology that I've shared with you on the session today. Being able to use implied volatility and expected moves to identify when the market might be vulnerable to a sell-off. There are other strategies and methodologies that members will learn in the trade room. One is our slingshot methodology, which is a very reliable way to determine if a market's likely to sell off. I teach that in the trade room as well. So they're all challenging, but I would say, probably because the .com crash was early in my trading career, that was the biggest eye opener, right? Is that things can change on a dime. And if you're not prepared for it, this is where people blow up accounts and all that. So that was probably a big transition. Let's see, got another question. Do we send out text or push notifications? Yeah. So anytime we issue an alert inside the trade room or outside of the trade room, we send a push notification to any of your devices. So there's instructions to set that up. We give you. But your smartphone, your tablet, your laptop, desktop, whatever device, and you're not limited to one. You can have it on all of those. We'll send you a push notification so you'll know immediately when we place a trade. And again, most of these trades aren't time sensitive. So generally, you have all that day and sometimes more than one day to get into these trades. The only exception would be if we're doing like a short, very short duration intraday trade inside the trade room. Let's see. And are there more alerts issued outside the trade room? Yeah. So on top of the trades that you get inside the trade room, we also issue alerts outside of the trade room. And again, those are sent out by push notification and email. So not only do you get the trades we do in the trade room, you're going to get additional trades outside of the trade room as well. I would expect, and again, it's going to be based on market conditions, but on average, you'll probably get somewhere between 5 and 10 trades a week. Just again, depending on market conditions. So, and I realize some people will have smaller accounts and may not be able to take every trade, and that's perfectly fine. You don't have to take every trade. Or some people gravitate towards one strategy and not the other. Some people don't trade options and only equities. We do all of those things, so you're going to have a lot of flexibility there to kind of pick and choose which trades you want to take and which markets or asset classes you trade and all of that stuff as well. So yeah, full flexibility there. Let's see the discount. So yeah, I see some questions on the 88% discount. And again, if you want to do the whole year up front, you get a bigger discount by locking in the full year. But if you do the 297 quarterly, you get the 88% discount. As long as you're a member, you're grandfathered into that discount. So we never raise the price on you, and we don't lock you into any contracts as well. So after your first quarter or your first year, whichever option you go with, you have the flexibility to decide whether you want to continue. And then if you do, you're locked into that discount for as long as you want. Let's see, another question. I'm new to trading. Can I still participate? Yeah, so I don't assume that any of our members know anything. So not only am I going to teach the strategy behind in the rationale or reasoning behind why we're placing these trades, I walk through step by step how to place the trade. So even if you've never placed the trade before, you obviously get access to my screen share, and we build the trade together. So inside the live trade room. So and then if we send an alert outside of the trade room, it comes with full instructions. You can literally copy and paste it or read it to your broker. So even if you're a newbie, yeah, I don't assume that you know anything. So good question there. Alrighty. Well, it looks like that's all the questions that have come in. I want to thank everybody for being here today. It was a real pleasure. But big thanks to John and his team for having me on. Appreciate that, and always a pleasure to be here. So, John, I'll pass it back over to you.
All right, Jeff, great presentation as always. To take advantage of his offer, click on the link on the chat box on the right. That'll take you to the dedicated sales page, which is only available today.